In this video, we'll go through how to input the income statement assumptions. So starting on the instructions and plan input worksheet, scroll down to section 8 for the income statement assumptions. There are just 6 assumptions to put in for the income statement. The first one is the annual interest rate earned on any cash on hand. This, unfortunately, is a very low interest rate environment, especially in the United States. But depending on your country that you're making the assumptions, put in whatever the prevailing rate is. If you have an operating account at a typical U.S. bank, for example, this might only be 1/4 of 1% or 1/2 of 1%, depending on how much you have deposited. So this isn't going to be a very large percentage, but you do want to make some assumption for what happens to the cash you have laying around as you pile up cash. The second input is the annual discount rate for your customer lifetime value calculations. Now you can put in 0% if you want to not have any time value discount for the lifetime value calcs, but most early stage startups have a fairly expensive cost of capital between raising equity and debt, etc. But especially if you have preferred equity and you're raising venture capital along those lines, I would submit that you should probably put in at least 10%. And the next input is to enter the bad debt expense assumption as a percent of revenue. This is highly sensitive to what type of industry and business model that you're in. If you're billing customers on their credit card prior to shipping or prior to delivering any service to them, then you'll have virtually no bad debt expense. But if you're taking risk on shipping goods and invoicing the client or customer and then waiting for them to pay, you will have some bad debt expense. Many businesses that are typical product or manufacturing businesses might have 1 to 2% of bad debt expense. The next input is to enter any existing loss carry forward amount. So this is only for companies that have an operating history of losses and have some tax credits. Just put that total amount of loss carry forward here, and that'll be burned up prior to any tax liability. The fifth input is the appropriate income tax liability. Now, more and more startups are being formed as LLCs, which are non-taxable entities. So in this case, just select whether it's a U.S. corporate tax rate, a flat corporate tax rate, or a pass-through entity. So in many foreign countries, there is a flat corporate rate, let's say 15% or 25%. If that's the case, simply select flat corporate rate and put in the percentage here for input number 6. If you want to select the U.S. corporate tax rate, then each year of our startup financial model plan has the correct corporate tax rate table built in. Or if you're going to select a pass-through entity where no taxes apply, simply leave input number 6 blank and put pass-through entity, and no taxes will appear on the income statement. So those are the 6 inputs for your income statement assumptions. Having put those in, everything else flows through according to those inputs.